Good morning once again. Uh, we are going to proceed with our lessons. We're going to introduce ledger entries. But before we do that, we're going to recap on journal entries. So, welcome. Journal entries. Again, you remember from our last class that journal entries flow from the accounting equation. So, accounting equation asset is equal to capital plus liabilities. We saw how journal entries are done when asset is purchased and expenses and revenue. So today we're going to look at liabilities. Some one or two examples, then we'll just be done. Now, let me give you an example where you buy a computer on credit. You buy a computer on credit. So this will be purchase of computer on credit. So if something has been purchased on credit, it means that no cash has been paid, which means there is no exchange of uh, cash. Now, it has been bought, uh, the settlement will be paid later on. Now, assume that the computer is 20,000. So, if the computer is 20,000, the first step is analyze the transaction. Analyze the transaction. And if you analyze the transaction, you will find it will be something like this. Computer is an asset. So asset has gone up, which is computer. This is 20K. So let me say this computer was 20,000. Okay. Your asset has gone up because you bought a computer, and then your liability has gone up again because you have increased your obligations, your future obligations. So this is computer payable. Computer payable. Okay, 20,000. Okay. So for every action, there's an equal and opposite reaction. You can see that what has happened in the left hand side of the accounting equation has been replicated on the right hand side of the accounting equation. The left hand side has gone up by 20,000. The right hand side has also gone up by 20,000. So the accounting equation balances. So how do we generalize? So this is analyze, then we go to generalize. So how do we generalize now? If we're to generalize, we go back to our matrix, which is asset is equal to capital plus liability. Now we realize that this works out like this: when asset increases, we debit, and when this side increases, we do what? We credit. Okay, we credit. Now let us see what we will do here. We will debit computer account because asset has gone up. So we will debit computer account, and then computer payable liability has gone up through computer payable. So liability, if liability goes up, we do what? We credit. So there's a debit and there's a credit. We debit computer account, we credit computer payable account, which is a liability account. So how do we translate it into writing? So this is basically like this. We will have date here, we'll have transaction number, we'll have description, we'll have debit, we'll have credit. The date I'm not given, transaction number, let me say 01, description purchase of computer, purchase of comp. Then now, no, I've missed, I've missed one thing here. I've missed the account column. So this is the account, this is the description, This is debit, this is credit. So we have account here is computer account, not asset account. Remember that very well. Description purchase of computer, purchase of home, and then computer account, what did we say? Asset has gone up through computer. So when an asset goes up, we debit. So we debit computer account by 20,000. Let me just write 20,000 there. And then on the flip side, the same transaction number, computer payable account, the same description. What we do now is we credit now computer payable because liability has gone up, so we credit computer payable by 20,000. And that is how we penalize this transaction. So, or one more transaction will suffice. So let us try something like sales on credit. So let me give you example number two. Example number two, which is sales on credit. So suppose a company has sold services. Let me use the example of services. Let me say you've done a consultancy for 20,000. So consultancy for 30,000 on credit. So consultancy for 30,000 on credit. Now, when you get the invoice, which is the source document, then you will have to record it in your books immediately without waiting for the cash to be paid, because accounting is done on accrual basis, not on cash basis. So what you do here is that you will first analyze the transaction. So analyze the transaction, how it affects the accounting equation. So basically, this consultancy for 30,000. So this is an income revenue. So revenue will make capital to go up. So capital will go up through revenue. Okay. But you've not received cash. Instead, you have invoiced your services. So basically, this one you will have receivables going up. So this is a receivable going up by 30K. This is also 30K. Receivables are also called debtors. Now, the left hand side and the right hand side balance. For every action, there's an equal and opposite reaction. Now, the next step will be to generalize. So how do we generalize this? Simple. Asset is equal to capital plus liability. So what will we do? Asset has gone up, so we'll debit receivables, and we will credit, because capital has gone up, so we will credit revenue. Remember, we credit revenue, not capital account. Revenue account, which has made capital to go up. So let us come to translating this into writing. So we will have date here, transaction number here, account here, description here. Then we will have debit and we will have credit. So date I've not given, transaction number, let me say 02, account. We will start with receivables account, but you can start with revenue. Doesn't matter. Receivables. Then this is sales, or let me call it consultancy. Consultancy services. Consultancy. Then we debit the receivables account by, how much was it? 30,000. 30,000. And then on the same date, the same transaction number, the account now that we're dealing with is revenue. So this revenue account, again, it is consultancy, but now we do what? We credit. Okay, so now We credit our revenue according to the matrix there, and we debit the receivables. If it were cash, we would have debited the cash account because cash is the asset that would have been affected if it was not on credit. Now, I want to introduce ledger very quickly. Ledger entry. So ledger is like this. Now, for a layman, a journal entry is basically the recording of transactions in the books of account. Now, when you record these transactions individually through journals, at the end of a period of time, you will have each account having its own page. So a ledger is like a page. If you understand like websites, we have if somebody has a website which has a page for, let me say, entertainment, a page for, let me say, religion and spirituality, a page for parenting. So all similar entries are posted in a particular page. So in accounting, that page is called ledger. So ledger, if it is, let me say, cash account, so all entries related to cash account will be found in the page of the cash page, which is the cash ledger. So I would want to use the term a page for a layman if you want to understand what a ledger means. It's just a page. Your statement, which you get from the bank, is a ledger. That is your page. With the bank, that is your page. Okay. So let me give this example, then we'll see how it works out. So let me say number one. Mwangi starts a business with 100K on 1st January. Number two, Mwangi pays 20,000 for stationery items on, let me say, card. Okay. So these two entries alone are the ones that we were going to deal with. Then we just end it there. Now the first one, how will we? So the accounting process is that with analyzing, then you journalize, then you extract ledger accounts, extract ledgers. Ledgers are the pages like I said. So this is the accounting process so far. We will have others like now we will have the trial balance. Let me call it trial balance. And then we will have income statement, and then we will have balance sheet or statement of financial position. This statement of financial position. This is the correct terminology nowadays. Balance sheet is a bygone era. Now, how do we extract ledgers for? How do we do our stuff up to this point? Now, the first thing here is that if this one happens, so let me just wrap this and cover this. So when this one happens, we will first analyze. So asset is equal to capital plus liability. Now when money start a business with 500,000, now assuming that is cash, what bank? Let me say your bank has gone up. Bank is an asset, what cash, but let me say it was in bank. Then capital has gone up. So this is directly capital by 100,000. So how will we so we have done this. How do we generalize this? Now this is what we will do. Now we will come up with date, transaction number, account, description or details, let me call it details this time around, debit, then credit. Okay. Now date is first, transaction number is 01, account number is bank. Then we say capital introduced, and then we debit bank account because bank has gone up. When an asset goes up, we do what? We debit. This is debit, this is credit. So asset has gone up, so we will debit with how much? 100,000. 100,000. The next is capital account has gone up, so we credit. The same details, so this 100,000. So this is journal number 1. Or we can use that. Then let me draw just a fine line here to make the distinction. Then on 3rd January, transaction number 2, we get account. Now 3rd January, Monday pays 20,000 for stationary items. So how do we analyze for this? Monday does what? Pays. Cash has gone down or bank for stationary expenses. So let us have it like this. So this one is a payment. So payment from the bank. So this is how much? 20,000. Asset has gone down by 20,000. Then there is stationary expense. Stationary is an expense item. It is not an asset. It is not. Stationaries are not assets. This one is also confusing. Let me explain. When you buy a pen or a paper or a foolscap, those ones, in their nature, they may be assets because they are expected to last for a long time. So there's an element of future economic benefits, right? But they are immaterial. By their nature, they are immaterial. A pen of 10 bob, foolscap of 200 bob doesn't need to be recognized as an asset. So we basically do what? We recognize this as expenses. And if you buy a pen, you don't expect it to last long in the organization, like assets are expected to do. You buy a computer, you expect it to last long, but pens and stuff, they don't last long. So stationery are treated as expenses. So this one, we will have stationary expense, which will make capital to go down. This is stationary expense, 20,000. So in stationary expense, so when capital goes down, now we debit, right? So we have here stationary expense, purchase of stationery, stationery expense account is debited by 20,000. And then we will have here a bank account. Asset has gone down. Now we credit with 20,000. And this is all. Now we will have ledgers, which are the pages. Now let me do the bank ledger. Now bank ledger will capture only entries, transactions relating to bank only. Okay, so we'll have this is the format of a ledger. We will have transaction number, original number. We have date. We will have details. We will have debit. We will have credit. Then we will have balance because it is a page that shows the running balance. This is bank ledger. So we go to this journals that we did. These are the journals that we did. These are the journals that we did. Any transaction affecting bank should be captured in the bank ledger. So this transaction, we will find it here. This transaction, we will find it here. Okay. Now, transaction number 101, date is first, details is capital introduced, and then according to the journal, bank ledger was supposed to be debited. So bank account, this is now the bank account ledger. Let me call it bank account. So this is the real account now. This one told us what to do with the account. Now this is now the effecting. We are effecting what our journal told us. Our journal told us to debit bank account ledger. So what we come here, we just effect it, which is 100,000. And our balance here will be now 100,000 debit. This sign is very important. Okay. Now we will have another entry here which affects the bank account. But before we do that, let me show you how capital ledger will look like. Capital ledger will be something like this. Capital ledger will be something like this. Capital account ledger. Capital account ledger. So we will have transaction number, date, details, debit, credit, balance. Okay. So this is still number 1, first, details, capital introduced. Then now we credit according to the journal. So this is 100,000, and the balance there will be 100,000 credit. 100,000 credit. Now this journal, we have posted it completely to the ledger. Now, what about this journal? There's bank account. So if there's a transaction affecting bank account, we don't create another bank page. We go on with this page because there's already a page established. There's already an account established. So we don't go on creating a new account. So we just effect this one. So on third, no, let me say this is a second transaction happened on third. Description is purchase of stationery. Purchase of stationery. Now, according to this journal, we were told to credit bank account. When you come here, we will credit this. We will credit it here, which is 20,000. Now the balance here will be 100,000 debit against 20,000 credit. So that this will be 80,000 debit. So it will be a running balance. You may have 10 transactions, 20 transactions, 50 affecting bank ledger. It will be a running balance up to the end of the period, of the accounting period. So I want to challenge you to try to do this stationery expense ledger, because according to this journal, there are 2 accounts which should be posted: the bank account, which I've done here, and the stationery expense account, which are not done. So challenge yourself with that one, and let us call it a day. Thank you, and God bless you.